Hi, welcome to lesson 3. So in this lesson, you'll be learning the most basic option strategy, which is buying a call or buying a put. It's as simple as that. But there are certain circumstances when we use this basic strategy. So when do we deploy the first strategy, which is going long a call? Recall that when we go long a call, the risk to return graph looks something like this, where we have limited downside and unlimited upside. It looks great on paper, but there are only certain circumstances that we want to use this strategy. So when do we deploy it? We deploy it only when we are very bullish on the stock or the futures or the currency that we want to go long on. And we expect the price to move up very sharply. You will learn later that when you simply buy a call and if the price moves up but not significantly enough, or it takes too long to move up, you could end up losing money. So we have to go into something that we are confident will move significantly within that short period of time before our option expires. The next thing is we only want to buy options, whether they are calls or puts, when they are relatively cheap. So recall that option prices depend very much on volatility. So we want to buy a call or a put when we have low implied volatility. When the implied volatility is low relative to the last 52 weeks. And we judge it by looking at the IV percentile on the Think or Swim platform. So general rule of thumb would be ideally the IV percentile should be less than 50% when we are buying options, because if it's more than 50%, it tells you that the market is very volatile and options tend to be really expensive. And again, when you're buying options and you're buying it when it's really expensive, it's going to be more challenging making money. Recall, in anything, we want to buy low and sell high. We also deploy it when we're looking for high risk and high reward. So buying a straight call seems simple, but it is relatively high risk compared to many other strategies that you will learn in this program. But it brings you the highest rewards at the same time. The next thing is we only want to use this strategy when we see the optimal technical pattern in the market. So in other words, based on the chart patterns, we see a clear indication that the price is going to move up sharply. Again, do watch the lesson, the bonus lesson on technical analysis, where I will show you exactly the best times to enter long on a stock or any other asset. So in general, we like to go long when the price is breaking out of a consolidation pattern, which means the price is going sideways in a consolidation and it's breaking out of the consolidation, triggering a move up. Or when the price is on an uptrend and is bouncing off a support level on an uptrend, usually bouncing off a moving average. So in this case, you can see the stock is on a clear uptrend and it's bouncing off the 50 moving average. And right as it bounces, we want to buy that call to catch the next move up. In this case, we want to buy the call as it breaks out of the resistance and before it starts moving up sharply. And we should only use this on high momentum stocks, which means stocks with very high volume and with rising relative strength compared to the S&P 500. In other words, we only want to go long on stocks when the stocks are relatively stronger than the overall market, which is the S&P 500. Again, all this is covered in detail in the bonus lesson on technical analysis. So once you've decided, okay, I'm really bullish, I'm going to buy a call. So let's take a look at an example right now. So I'm looking at P&G, Procter & Gamble, and again, what pattern do you see on the charts? We see a clear uptrend where the price is making higher highs and higher lows, and the moving averages are in sequence from the smallest moving average to the biggest moving average. And currently the price is making a dip and finding support at one of the key moving averages, in this case at the 100 moving average. So right at this point, we anticipate that the price is going to bounce and continue the trend up. So we are bullish on this stock called P&G. And currently, from the chart, you can see that the stock is, the market price is $90. That's the current market price. And let's imagine we think it will reach $98 within the next month or so. So that's our initial target price. So again, current price $90, and this is the 24th of December 2018, and we are targeting a $98 profit target in the next 1 to 2 months. So based on this scenario, we want to buy a call. We're going to go long a call. So we could buy the at the money call. Recall what you've learned in lesson 1. So if you buy at the money call, we'd buy the PNG 90 call. And again, what is 90? 90 will be the strike price. So we are buying it at the strike price of 90 when the market price is at 90. So we're buying at the money. And it expires in March. So when we buy a call, we want to ensure that we have at least 60 days to expiration or more. So given that it is now the 24th of December, if we buy the March 2019 calls, we have got 81 days to expiration, which is more than 60 days. All right. Next, because we are selecting the 90 strike price, we're selecting at the money. Now, different traders have different trading styles and preferences. My preference is to buy the option which is at the money or slightly in the money with a delta of about 0.5 to 0.6, and that is my style of trading. And I'll discuss the pros and cons of buying deeper in the money or even out of the money. But my preference again is buying at the money or simply one strike in the money. So based on this scenario, we buy the PNG March 90 calls. So if you check the option chain, you would see that it is selling at $4. So, excuse me, $4 would be the option premium or price that we pay to buy this call option. Imagine we buy one contract of this call option, so that gives us control of 100 shares. So in this case, what would our risk to return graph look like? Remember, whenever you buy a call, think of the Nike sign. So the Nike sign is something like that, right? So we have got the minimum, or rather we have got the maximum loss, which is capped, and maximum return. So it looks something like this. So a few questions that we have to look at. Number one, what's our maximum risk in this trade? Again, when you buy a call, the maximum risk is the premium that you pay. So what's the premium that you pay in this case? $4. $4 multiplied by 100 shares. Remember, one contract is 100 shares. So your maximum risk would be $4 multiplied by 100 shares. That's $400. So the moment you know your maximum risk, you would state it over here, which is the bottom of the Nike sign, right? So the maximum that I would lose, again, this shows you the profit, this shows you the loss. On the y-axis, on the x-axis, we have got the stock price. So this is a higher stock price, that's a lower stock price. So the maximum risk is $400, and that happens if the option expires worthless by the expiration date. If it expires out of the money, you lose $400. Now you will learn later in this lesson that as option traders, we never ever allow the option to expire worthless. We never want to lose the maximum. In fact, the majority of the time, if I'm in a losing trade, I will exit the moment I lose 50% of my maximum premium, which means the most I would lose is 50% of my total risk, which in this case is $200. And that's how I trade. And I'll tell you again, when would you want to cut your loss and exit a trade when that happens. Cool? Great. Now, the next thing is to know what is your break-even price. When you buy a call option, you're hoping the price is going to go up. If it stays where it is or goes down, you're going to lose money. But it has to go up by a certain amount in order for us to break even. Because recall that we are paying a premium for the call option. So the price has to move by the amount of premium at least to break even on the trade. So what's our break-even price? Bear in mind your break-even price at expiration. Recall, at expiration, there's no more extrinsic value, which means there's no more time value and no more volatility. So at expiration, the only value is intrinsic value. Recall that from lesson 1? Okay. So at expiration, what's the break-even price? Your break-even price would simply be the strike price plus the premium that you pay. So the strike price is, in this case, $90 plus your premium, which is $4. So you add it up, it should be $94. Sorry, there's a bit of a typo over there, $94. So the break-even price is $94, as you can see over here. So you can see that at expiration, this green and red line is the profit and loss graph at expiration when there's no more extrinsic value, when it's purely intrinsic value. So you can see that the price has to move beyond $94 for you to break even on this trade. If the price stays at $90 or goes below $90 or goes between $90 to $94, you're losing money if you hold it to expiration. All right, it's got to go beyond $94. Cool? Okay, great, we understand that. Next, you need to also know what is your potential profit at your target price. So in this case, our target price was $98. So we are targeting a $98 target price in a month or so. So at $98, what is the profit we will get at expiration? So from here, you can see at $98, our profit at expiration would be $400. And again, we just plot it to where we see this line over here, the Nike sign, if you will, right? So how do you calculate that? The profit at expiration would be the stock price minus the strike price minus the premium. So if it reaches $98, what does it mean? It means that we have the right to buy it at $90 because of the call option. We have the right to buy it at 90 and sell it at 98, which means we have got an intrinsic value of $8, correct? So see, $98 minus $90, $8 intrinsic value. But we have to deduct $4 because of the premium that we pay. So 98 minus 90 minus 4 is $4. Multiplied by 100 shares, our profit at expiration will be $400. So some of you may be thinking, wait, so Adam, you're saying that I'm risking $400 to potentially make $400. That's one-to-one. That's not really exciting, right? Well, there are a few things you have to understand. Number one, like I mentioned, we hardly ever hold it to expiration. In fact, one of my rules is I always sell the option, I exit the option whenever there's 30 days left to expiration. Okay, so if you exit the option 30 days to expiration, you still have some extrinsic value left. So the option will be worth more than at expiration. And I've also mentioned that we hardly ever allow ourselves to lose 100% of the option value. Usually, by the time we lose 50% of the option value, we cut our losses, which means my actual risk is not $400, it's about $200 in that case. Make sense? Okay, I'll talk more about that later on. The next thing you have to understand is, now besides this line that you see, notice you see these dotted lines over here. You've got this dotted line over here and this dotted line over there. So what are these lines? Now, the moment you buy the option, in this case, you have got about 70 days to expiration. So this is the profit and loss line right now today. Sorry, it's 81 days to expiration, okay? So when you buy the option right now, you've got 81 days to expiration. So your profit and loss graph looks like this. And as it nears expiration, the profit and loss graph will then slowly move to this. So in other words, if you exit the option way before the expiration date, you actually get a lot more money because you have got extrinsic value left. But at expiration, there's no more extrinsic value. What you're left with is intrinsic value, which is a lot less. Got it? So you can see that if you buy the option today, right now, when there's 81 days to expiration, follow this dotted line. And you can see that currently our break-even price is $90. We break even at $90, which is the price today. But as we wait and as it moves towards expiration, notice the break-even price from $90 would eventually move to $94 at expiration. If the price can reach $98 right away, notice that we will make a lot more money up here. We will make a lot more money than $400 because we have got a lot of extrinsic value left. But again, if we wait to expiration and the graph begins to come down to this line, then we will make only $400. And that's why when we buy a call option, we want the price to move significantly as fast as possible, because the faster it moves and the faster we sell the option, the more profit that we make. So we buy the option at a low price, we sell it at a high price, and we take as much profits as we can. So to ensure you understand what I'm talking about, let's get you to do an exercise. So please get your pen ready and please get ready to answer these questions. So let's look at another scenario where we see a bullish setup on McDonald's. And again, if you look at the chart, you can see McDonald's is on a clear uptrend, making higher highs and higher lows, and it's bouncing off the moving average. And right now it's finding support right at this moving average, and we anticipate it's going to bounce up. And so we're really bullish. We're anticipating a sharp move up. We're going to buy right now. And currently the price is $175. And we anticipate that McDonald's would go up to $193 in the next month or so. So we decide to long a call. And we decide to, again, buy the at the money call. So the at the money call would be the McDonald's March 175 call. So the market price is now 175. If we buy a call with the strike price of 175, it is at the money. And the premium that we pay in this case is $8 premium, which we can check from the option chain. We also select the March calls because currently it's December. So the March calls will give us at least 60 days to expiration or more. So based on this scenario, I'd like you right now to pause the video and to write down your answers to these questions. Please do so. And once you have done it, I'll review the answers with you. So let's run through the questions really quickly. Number one, how much would it cost you to buy one contract of the McDonald's March 175 calls? What's the total amount you got to pay? Please write down the answer. Next, what's your maximum risk? What's the worst that can happen if you do not manage the trade at all? Number three, what is your break-even point if you hold it to expiration? Okay. By the way, the hint is over here. That's the hint. That's how you calculate it. Okay. Next, question 4. If McDonald's goes to 193 before the expiration date or at the expiration date, what is the minimum profit you would earn? Again, if it reaches there before the expiration date, you'll make a lot more profit because of the extrinsic value. But what's the minimum profit that you will make if it goes to 193? So again, hint, take the stock price minus the strike price minus the premium and you get your answer. Please do it right now. Finally, and I really want you to do this exercise, it is critical that you learn to draw the risk to return graphs, because when you draw it, you would really understand how the trade works. So I want you to do your best to draw the risk to return graph, which is the Nike sign. Okay, I want you to draw that Nike sign for me. And on that chart, I want you to indicate where's the maximum risk, where's the break even at expiration, and what is the profit you will make minimum at expiration if the price goes to 193. So please pause the video right now, do this exercise, and once you're done, play it again and we'll review the answers. Ready? Go. Alright, so have you done the exercise? I hope you have. If you have not, please do it right now. Pause the video, go do it. Right? I can see you. I know when you're not doing it. Alright, so I assume you're doing it. All right, so let's review the answers. How much would it cost to buy one contract? So again, the cost would be the premium, and the premium would be $8 for one share. So multiply that by 100 shares. So one contract is 100 shares. So your total premium would be $800. Did you get that? If you did, give yourself a pat on the back. All right. Next, what's your maximum risk? Your maximum risk is the premium that you pay, which is again $800, which like I said, in reality, I'll never allow a trade to lose its maximum premium. I would usually cut my loss when I lose 50% of the remaining premium, and I'll cut losses 30 days before expiration. Next, what's your break-even point at expiration? So to break even on this trade at expiration, it's basically your strike price plus your premium. So what's your strike price? $175. What's your premium? $8. So you take $175 plus $8. Your break-even price would be $183. All right, let me just write it down. Break-even price at $183. Max loss at $800. Next, if McDonald's goes to 193 by the expiration date, what's the minimum profit you will earn? So how much would you make if it goes to 193? So remember, if you buy a call option, you have the right to buy the shares at 175. You have the right, but it's now at 193. So theoretically, you could buy at 175 and sell at 193. Correct? So what's the intrinsic value of the call? The intrinsic value would be 193 minus 175, which is the stock price minus the strike price, which is the intrinsic value at expiration. Right? So again, 193 minus 175 is $18. So 193 minus $8, minus 175, that gives you $18, right? And $18 minus the premium of $8 would be $10. All right, so your minimum profit would be $10 multiplied by 100. That would be $1,000. That would be the minimum profit you would make if McDonald's goes to 193 at expiration. And again, if you sell it before expiration, you get more than $1,000 because you have got the extrinsic value on top of the intrinsic value over here. Finally, draw the risk to return graph. So before that, let's look at what we have. We know that our maximum premium is $800. We know our break-even price is 183, and we know that our maximum profit at expiration is $1,000 if McDonald's goes to 193. So with all this, how would we draw the graph? Let me erase that. So I'm going to go on a blank slide right now. And again, whenever you want to draw the risk profile of a long call, what do you do? First thing, draw your Y and X axis. So we've got our Y axis, supposed to be a straight line, okay? We've got our X axis over there, supposed to be a straight line. And again, this would be our profit, this would be our loss. And on the X axis, we have got our stock price. There we go. So the first thing would be to draw your maximum risk. And our maximum risk would be $800, which would be here, minus 800. That's our maximum risk. Okay, so once the stock price goes below a certain level, we can only lose $800. That's our maximum risk. So remember the Nike sign. So the Nike sign goes like that. Right, as the stock price goes up, we have unlimited profits. Stock price goes down, we've got limited loss. So the question would be, what would this break-even price be? And again, this line that we see is the profit and loss graph at expiration, okay? At expiration, when there's no more intrinsic value left at expiration. So our break-even price we calculated was 183 over here. That's right, 183. There we go. And if Nike's price goes to 193, which is somewhere over here, how much would we make? If it goes to 193, we should make $1,000. There you go. Right? So that's how your graph looks like. Right? So again, just take note that this line that you see, this is the profit and loss graph at expiration. But the moment you buy the call option, recall that you have many days to expiration. You've got at least 60 days to expiration, which is about more than 2 months, which means you've got extrinsic value. So currently, the graph does not look like that. It looks a bit different. It would look something like this. The current price is right now at 175, which is somewhere here. 175. That is the current price today, right? So there will be another line like that. The dotted line, which I mentioned before, that's right. So the dotted line would be the profit and loss graph today, which would be, for example, it could be, for example, 60 days to expiration, all right, right now. So again, as you have 50 days left, 40 days left, 30 days left, and 0 days left, as you move to expiration, the graph would start to slowly move to this line eventually. So as you can see, when it's far from expiration, our break-even price is lower. But as we move to expiration, the price has to move a lot more in order to break even. And if we can hit our profit target before expiration, we can actually potentially make more money over here. For example, 1,002 or 1,003, because we have got the extrinsic value above the intrinsic value. So the difference between where we are now and expiration, the difference over here is basically the extrinsic value that's left that will slowly decay and go to 0 by expiration. So that's how the whole thing works for long a call. So let's run through the advantages and the risk of buying calls. Now, the most obvious advantage would be it's a simpler strategy. Just buy a call and that's it, all right? At the same time, again, buying calls gives you limited risk. The maximum risk is the premium that you pay and unlimited returns. And when the price moves sharply up, you have the highest return among all the other strategies that you will learn. You're able to control high price stocks with minimum capital, so it's definitely giving you an advantage over buying the shares itself. And again, it allows you to magnify your returns with a very high return on investment. Most of the time, you find that for winning trades, your return on investment will be more than 100%, which means if the premium is $500, you could make $1,000 or $500, which is 100% return or 200% return. However, there are disadvantages of buying straight calls. And the first disadvantage is it is relatively expensive compared to other strategies you will learn later on, which are call spreads. Because when you buy a call, you're paying that premium that can be expensive. So to break even, the stock price has to move past the strike price and the premium at expiration. So again, to get over this disadvantage, we ideally want to buy calls when we are really sure the price will move up fast in a short period of time, so we can exit and take our profit before expiration. Remember, the longer we wait to expiration, the harder it becomes to break even, because there's no more extrinsic value left in the option we have bought and it becomes worth less and less. Next, there's a risk of loss if the price does not make a large move up within the expiration date. So bear in mind, when you buy a call, you only make money if it goes up within a short period of time. If the stock price goes up but takes too long to go up, by after expiration, you lose money. If the stock price goes sideways or goes down, you also lose money. So you can only make money if the price goes up within that short period of time. So timing is critical when buying calls. Again, you lose money if the price goes down or goes sideways. You lose money if the price takes too long to move up or does not move up enough beyond the strike price plus the premium at expiration. The other risk of buying calls is that as time passes, what happens? Your theta, you have theta decay, which you've learned in lesson 1. So every day that passes, your option becomes worth less and less. It decays as it loses time value. The other risk would be that if volatility falls, the option premium will fall, the option price will fall, and you could end up losing money. So that's why sometimes if you buy calls when implied volatility is very high, it means you're buying calls when they're really expensive. So even if the stock price goes up, but if volatility falls, you may find that your call option loses value even though the price goes up because the implied volatility has fallen. And that's why it is important to buy when implied volatility is low in the first place, and risky to buy when implied volatility is high. So these are the advantages and risks of buying calls. All right, so let's run through the steps that you need to take before you buy a call. And step 1 is to first identify a bullish trade based on technical analysis. So again, refer to the lesson on TA to know exactly when to go long. So ideally, you want to, before you buy a stock, an index or ETF, you want to ensure it is there's a high probability of the price moving up in the short term. So it should be making a dip on the uptrend or breaking out of consolidation. And if you're trading a stock, it should be a high momentum stock. So once you've identified the trade, step 2 is to look at the IV percentile of that stock. So again, we ideally want to buy options when the IV percentile is 40% or below, because that's when options are relatively cheap. When the IV percentile is 50% or more, then you're buying options when they're expensive, and it's a bit more risky. Because once you buy the option and the volatility drops, your premium for your call could also drop as well. So that's why you should stick to buying only when IV percentile is below 40%. Unless you're really confident that the stock is going to rise up really quickly, and then you take the trade even if IV percentile is high. In other words, even when options are high, you're still buying because you think it's going to go even higher. So you can do that under certain circumstances. It's not a hard and fast rule, but again, my advice to be safe would be to check the IV percentile, and it's below 40%. Next is to check the option chain. So once you click on the option chain, for example, if you're trading Facebook, look at the option chain. The first thing is to choose which date to expiration, which option are you selecting. So we ideally want to select an option with at least 60 days to expiration. And the reason is when you buy a call or buy a put for that matter, okay, you like to exit the option at least 30 days before expiration. Recall in the last 30 days, time decay is the fastest. That's when theta accelerates. So you want to get out 30 days before expiration, before the option loses most of its time value. So because of that, we'd like to ideally have the stock move in our direction to our target price within 30 days. So we can exit with 30 days left, hence 60 days. Next is to choose the ideal strike price. So when you buy an option, you could buy deep in the money with a very high delta. You could buy at the money, or you can buy out of the money. So there are pros and cons to each method. My preference is to buy the option which is at the money or slightly in the money, by one strike in the money. So how would you know? Well, look at the delta of the option. So usually I choose a delta of 0.5 to 0.6. Recall what that means. This means that your trade has a 50 to 60% probability of expiring in the money. So that's what it means as well. It also means that if the stock price moves up by $1, your option will move up by 50 cents with a 0.5 delta and 60 cents with a 0.6 delta. But again, as the stock price goes up, the delta changes as well. The delta will keep increasing till it reaches a maximum of 0.9 or 0.99. Next would be to choose the number of contracts to trade. Again, the minimum would be to select one contract, and one contract would be equivalent to 100 shares. So you could select 2 contracts or 3 contracts, up to you. So my suggestion again is to manage your risk. So you should trade the number of contracts such that the total premium you're paying be less than 2% of the net liquidation of your portfolio. So net liquidation refers to your total capital. So in other words, if your total capital is 10 grand, you should not be buying premium of more than 2%. Again, 2% of 10 grand is $200. So you should not be risking more than $200. Again, recall that I never allow my options to lose all their value. I would usually cut loss. If I'm in a losing trade, I'll usually cut loss if my options are losing half their value, which means in actual fact, my actual risk is 1% of my total capital, which would be $100 for 10 grand capital. Now, I know some of you who have got small amounts of capital, starting with a 2 grand or 5 grand account, this could be a bit challenging because one contract is 100 shares. So sometimes just by buying one contract, the total premium could be 5% of your account. So I can understand that if you've got a small account, then you may have to go up to 5%. But my suggestion is not to exceed 5%, because when you're risking 5%, your actual loss could be 2.5% in a losing trade. And if you have too many losing trades, you could have a big drawdown on your account. The next step is to analyze the risk to return profile of the trade. So in this lesson, I got you to draw the Nike sign, right? To see the maximum risk and the potential return and the break-even point. Now, in reality, you don't have to draw the graph yourself, right? The software will plot it for you. So using the Think or Swim Analyze tab, you can analyze the trade. You'll draw the risk to return profile, so you can see exactly what's your maximum loss, what's your break-even point, and what's the potential profit you will get when the stock price reaches certain levels. So once you click the Analyze tab and you look at the risk profile, check your potential loss and your potential profit at different prices. So if the stock price goes there, how much do you make? How much do you lose? So, check it out. And you want to look at your potential loss and profit 30 days before expiration, because that is normally when we will decide to exit the trade at a loss or even at a profit. So once you're happy with that and you say, okay, I like the risk to return profile, I'm risking this amount of money to make a lot more, I think it's a great trade, so you decide to place your order. So what I do is I wait for the market to open. Once the market opens, I'll place a limit order. So you can place your limit order at the ask price if you are very confident. You want to fill the trade right now, you buy the ask. If you want to kind of like bargain a bit and say I want to get a better price, you could put your buy order at the bid. Or you could put your limit order between the bid and the ask, which is called the mark price. Right? If you're not too sure about that, let me just explain a bit more. So again, when you look at option prices, you would always see a bid price, and you would see an ask price, and you would see the last closing price of the option. So for example, the ask could be $1.20. The bid could be $1.15, and the close, which means the last transacted price, could be, again, maybe $1.20, for example. Right? So what does bid and ask price mean? So ask refers to the price that sellers in the market are offering their options for. So these are the sellers saying, okay, we're willing to sell the option at $1.20. And bid would be the buyers in the market willing to buy at $1.15. Okay, so $1.20 is what sellers are asking for. $1.15 is what buyers are willing to buy at, right? So now, right now, you are a buyer. You want to buy the option. So if you want to buy the option right now, you want to get your order filled right now, you buy it from a seller. So whatever the seller is asking for, if they're asking for $1.20, you buy at $1.20. So if you put a buy order at 120 limit, you usually get filled pretty fast. But if you're thinking, you know what, I want to queue up and see if I can get a lower price. So you could put your buy order, your buy limit order at 115 at the bid price, which you may not get it if the price goes up. What some traders do would be they look at the middle between the bid and the ask. They take the center, that's called the mark, right? M-A-R-K, and they place the buy limit order at the mark. You can do that as well. So it really depends on, again, how desperate you are to get in the trade. If you want to get in right away, you buy it ask. Okay, if you're willing to bargain and say, okay, let's see how, if I don't get this price, I don't want to get in, you could put your buy at the bid or at the midpoint, at the mark, right? And before that, finally, if you notice that the bid-ask price, the spread between the bid and ask is more than 40 to 50 cents, a wide spread, usually we skip those trades. It usually means that these options are not too liquid. There's not enough volume, and it's not worth taking the trade. So now you know the steps of how to go long on a call. Let's now take a look at the steps of how do you exit a call at a profit or even at a loss at times. So let's take a look at the first scenario. And the first scenario is the stock price goes up as you anticipate. So if it goes up, what happens to your call option? Your call option becomes more valuable. So as the price goes up, your call option will increase in value, increase in price. So when would you sell the call option? Here are a few reasons you could sell. So the first one would be to sell the call option at the profit once the stock price has reached the intended target price. So you've entered the stock and you've got a certain target price. Once the stock price has reached your intended target price, you then sell the call options for profit. So you buy the call option at, say, $8, you sell it at $16, you made an $8 profit out of $8. So that's a 100% return, okay? Or you could also sell the call option once it has doubled in price. So again, the price of the call option would be the premium that you pay. So again, if the premium is $4 and now the option is $8, you have doubled your money. And you could also exit when that happens. The next scenario would be to sell the call option the moment it reaches 30 days to expiration to avoid the fast theta decay during the last 30 days. So the moment you've got 30 days left, get out. Sell the option with whatever profit you have. So we choose whichever comes first. So either the stock price reaches the target price, or the options double in value, or we reach 30 days to expiration. Any of those things happen, we exit our call and take our profits. So that's the first scenario. The second scenario is something which is rarely practiced by option traders. Now, in theory, there are people who do this, but I've never done it. And most of the time, option traders do not do this, okay? Which is by the time it expires and the stock price goes beyond the strike price, in other words, it goes in the money, you then exercise the call option to convert it to shares at the strike price. Then you sell the shares at the market price and earn the difference as profit. So, for example, let's imagine you buy a call option with a strike price of 80. Okay, that's your strike price. And by expiration, the stock price is now at $90. So your call option is $10 in the money, correct? It's got an intrinsic value of $10. And most of the time, you will just sell the call option and take that $10 profit, and that's it. But what some people would do would be, they would say, okay, I'm going to exercise the call option. So what that means, when you exercise the call option, you now telling the broker, okay, I want the right to buy the shares at $80. So what will happen would be, you would physically buy the shares at $80. So the total amount of money required will be deducted from your account. You will have $80 worth of shares that you bought, and you can take the shares and you can sell it at $90 and take that $20 profit, which again is a roundabout way of doing it. And that's why I say it is rarely practiced, but I'm putting it as an option, as a scenario. Now, scenario number 3 is when things don't go the way you want. So you buy the call option, you think the price is going up, it doesn't go up, it goes sideways, goes down, or goes up too little, okay? And you're losing money. So when that happens, you have to cut your losses. So we sell our options at a loss when the option loses 50% of its value. So again, usually when I'm losing 50% of my premium, I'm cutting my losses. Or if the options reach, again, 30 days to expiration, I cut my losses. Or if I notice the stock price itself is no longer on an uptrend. So the stock price has broken below the support. It is now looking like a downtrend. It's making lower highs and lower lows. Or it is hitting where you would normally put a stop loss at the price chart, which is normally when the price goes below the previous swing low or the recent swing low, or breaks 1 ATR below the support level. So for example, is the price going up, making an uptrend, goes up, right? And again, this is covered in the technical analysis lesson. Please watch that. So let's imagine this is your moving average support. And these are what we call swing low. So this is a swing low, this is a swing low, there's a swing low, all right? So when it bounces off the moving average, you anticipate that the price is going to go up, all right? So you buy maybe somewhere over there, okay? But once you buy, what happens? It doesn't go up as you anticipate, it goes down, and it goes below this swing low. Remember, an uptrend makes higher lows, higher highs and higher lows. So the moment the price goes below this low, it means the uptrend is broken, which means no longer an uptrend, get out, right? And take whatever losses you have on your call options. So again, like I mentioned over here, we rarely allow a loss of 100% of the option premium. We normally exit a trade when we lose 50% of the option premium or less. And that's how we exit a long call trade.